Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that's pretty popular in the stock market right now, and that is DocuSign. And we can see that over the last year, this stock is down about 70%, and this stock really picked up in terms of popularity and growth around the global lockdown measures that happened in 2020 and 2021. We can see that this stock increased pretty substantially up to around an all-time high of around like $200 to $300 per share. But since then, it's fallen all the way down to what is now around $50 per share. So it's trading right around where it was when it went public in 2018. And so because of that, it might present a good buying opportunity at the moment, coupled with a couple of other certain news events that have recently come out surrounding DocuSign, as well as the positive growth prospects we're going to see from their financial statements. And so in looking into that, we're going to figure out what the intrinsic value per share of DocuSign is, so we can figure out if this is a good buying opportunity at this current share price. But before I get into that, we can see right here, I found this little statistic on Google that shows the market share of leading electronic signature companies, including DocuSign and their competitors. And we can see that DocuSign pretty much holds a monopoly almost over the electronic signature worldwide industry. We can see they have about 77% market share, and none of their competitors even come close to having as much market share as DocuSign. So it'll just be a question of whether or not they'll actually be able to convert this market share into positive revenue and earnings growth moving forward. Also, I found this article right here that talks a little bit about the potential recovery for DocuSign stock in the future. They touch on how DocuSign delivered pretty strong results in their third quarter earnings report, but that investors still might want to approach DocuSign with a little bit of caution. And as I pointed out in the start of the video, they touch on how during remote work and social distancing, DocuSign really picked up a lot of adoption from companies who were making transactions online. But as people started to move back to face-to-face and the status quo, DocuSign's growth pretty much fell off of a cliff. And then they talk a little bit here into some of the earnings results that came out in their third quarter. I'll get into these in a little bit more detail when I look at their financial statements. But one measurement that I really want to pay attention to here was this one in the last line of this paragraph. One contradictory metric, however, is its net dollar retention rate, which slipped again to 108%, down from 110% last quarter. And basically what a net dollar retention rate is it's a metric that companies use to measure their year-over-year performance. And basically, it's the amount of revenue that a company brings in a given year from their previous year's existing clients. And so it doesn't factor in the revenue from clients acquired in the present year. And so basically what that means is, especially for a company like DocuSign that has a subscription-based revenue model, it basically shows how much revenue DocuSign is bringing in from previous customers as opposed to new customers that they acquired this year. And that's pretty important because if their retention rate is decreasing, then that means that in order for them to increase their revenues in the future, they have to acquire new subscribers, and they can't just rely on the revenue from old subscribers that are coming back to continually use their service. And so in DocuSign's case right here, we can see that decreased from 110% to 108%. So we'll see how that plays out in the future for their subscription revenue model. But right here, we can see their balance sheet for October 31st, 2022 compared to January 31st. And over that time period, total assets are up about $200 million from $2.5 billion to $2.7 billion. And we can see the vast majority of their business financed by liabilities, with $2.2 billion worth of liabilities. It's pretty much stayed the same over this period here. And then they have total equity that's increased by about 100% almost, from $275 million to $468 million. But unfortunately, the two main line items we want to focus on here are accumulated deficit and additional paid-in capital. They have an increasing accumulated deficit, which is basically the opposite of retained earnings. It's what happens when a company's operating history is essentially just made up of net losses, and they end up having an accumulated deficit on their balance sheet from the total net operating losses they've accumulated since inception. And then they have an additional paid-in capital line item that's increasing from $1.7 billion to $2.1 billion. And this tends to increase when a business is issuing new shares of common stock as a means of acquiring capital to finance their business operations. But unfortunately, when you do that and you add new partners to the company, you end up diluting previous shareholders, and as a result, the stock price for a company's stock could decrease, which is really not a good sign for investors who are holding onto DocuSign. If you are an investor in DocuSign, you typically want to see additional paid-in capital decreasing because that means a company is buying back shares and thus increasing the share price of their common stock. And so right here on page 5, we can see their income statement. We can see subscription revenue is up year over year from $528 million to $624 million. So that's an increase of about 18% year over year. And then professional services income is up from $16.8 million to $21.4 million. And so that's an increase of about 27% year over year. And so in total, revenue is up about 18% year over year. But that being said, we can see gross profit has increased even faster than revenues have, because their gross margin for 2022 was about 80%, whereas their gross margin for 2021 was about 79%. So that means that their total revenues increased faster than their total cost of revenues did. And as a result, their gross profit ended up increasing more than their revenues. But unfortunately, we can see right here on their bottom line, they had a net loss of $29.8 billion, mainly as a result of their operating expenses here, which were larger than their gross profits. At $543 million worth of operating expenses to operate their business, mainly from sales and marketing expenses, but they only had $550 million of gross profit. So they end up having a net loss here, which is actually increased from a net loss of $5.6 million in 2021. So definitely not a good sign to see that a company's net loss is increasing. Obviously, the fact that most of their expenses went into sales and marketing shows that they're probably prioritizing trying to grow the company at the moment and increase their top line revenue, as opposed to keeping money in the company and producing positive earnings year over year. And so that could be a good sign or a bad sign, but we'll see how that pans out for DocuSign in the future. And so lastly, right here, if I go to page 8, we can see their cash flow statement for the first 9 months of 2022 compared to 2021. And during that time period, their net cash from operating activities came out to be about $369 million. And about $52 million worth of this came in the third quarter. And that's down from $418 million in 2021, when they had about $105 million in the third quarter of 2021. So there has been a decrease in operating cash flow year over year. Their free cash flow metrics are also down in the third quarter from $90 million in 2021 to about $36 million in 2022. But that being said, we can see they are still prioritizing returning value back to shareholders through repurchases of common stock. They've repurchased about $63 million worth of common stock in 2022, and about $38 million of that came from the third quarter. And so it's interesting to see that even in a period of net losses and decreasing operating cash flow and free cash flow, that they're still prioritizing returning value back to shareholders by repurchasing common stock. So that could be an indication that management believes that the company is currently undervalued at the current share price, since they're buying back shares. And so based on that, coupled with the fact that they had increasing revenue growth and the fact that they hold a pretty substantial piece of the total market share of this industry, they could potentially present a good buying opportunity at this current share price. But to delve even deeper into that, I have a discounted cash flow model here to figure out the intrinsic value per share of DocuSign based on their projected free cash flow for the next decade or so. We can see that the growth rate projected by Yahoo Finance for the next 5 years is about 20%. They had about $477 million worth of free cash flow in 2021, about $137 million worth of cash on their balance sheet after subtracting debt, and about 201 million shares outstanding. And so that puts their intrinsic value per share at $59 per share, with a 30% margin of safety of $41 per share. Which means that DocuSign is currently trading in between a 30% margin of safety and their intrinsic value per share of about $59 per share. So based on their projected free cash flows and their growth rates of about 10 to 20% for the next decade per year, it means that DocuSign is potentially presenting a good buying opportunity at the current share price of $49 per share. Also on the right hand side here, I did a competitor analysis trying to compare them to some of their competitors. It was kind of difficult to compare DocuSign to their competitors because most of their competitors are subsidiaries of larger parent companies such as Microsoft and Adobe. And a lot of the competitors that they do have are private companies, so they aren't publicly traded, so it's kind of hard to find information on those companies. But based on this, we can see I'm comparing DocuSign to SignEasy, which is another electronic signature company that's a subsidiary of Microsoft. And then I'm also comparing them to Acrobat Sign, which is a subsidiary electronic signature company owned by Adobe. But unfortunately, I can't really get the financial metrics for those subsidiaries, so I ended up using the parent company financial ratios, which makes it a little difficult to compare the companies against each other because obviously Microsoft and Adobe have a lot of other operating segments than just their electronic signature company, whereas DocuSign is a full-on electronic signature company. And so in comparison, we can see DocuSign has a middling gross profit margin relative to Microsoft and Adobe, and they're also not profitable in comparison to Microsoft and Adobe. So this competitor analysis isn't really that reliable in my opinion, just because there's not that much information surrounding DocuSign's competitors. And then on top of that, we saw that in comparison to their competitors, when I brought up that article with that statistic, they do own about 77% market share in this industry. So in that regard, if we're going to do a competitor analysis from that perspective, they're obviously very dominant in this industry when it comes to market share. But as far as analytical, like statistical financial ratios goes, it's kind of hard to compare them because a lot of their competition are just subsidiaries of parent companies. But from an intrinsic value standpoint, we can see DocuSign is trading below their intrinsic value per share at the moment, and they are trading very near their share price when they went public in 2018. So there could be a lot of growth potentially for DocuSign in the future. They do currently only have a market cap of around $9 billion. So a lot of room to grow for DocuSign. I'm not sure if I'll be buying into this company at the current share price, but it is interesting to see that this company could potentially have a really big recovery in the future. So let me know in the comment section down below what you guys think of this company. Is it a buy or a sell at the current share price? Let me know what you guys think. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.